Just a month ago, Wall Street was nearly certain the Federal Reserve would cut interest rates in December. Odds were at 94%. That confidence has vanished. Now the chance of a rate cut is a coin flip, reflecting deep uncertainty. What changed? A swirl of mixed economic signals, a government data blackout, and most crucially, a divided Fed. When the Fed's path is unclear, businesses hesitate, consumers delay big purchases, and markets get jittery. The December meeting is now one of the most unpredictable in years, with the stakes higher than ever. The Fed, once seen as a steady hand, is now openly conflicted, leaving the financial world anxiously waiting for clarity. The shift from near certainty to uncertainty isn't just about numbers, it's about an economy at a crossroads, with every American feeling the impact. Inside the Fed, a sharp divide has emerged between two camps, inflation hawks and recession worriers. The hawks fear that cutting rates too soon could reignite inflation, eroding family budgets and destabilizing the economy. They want to keep rates high to ensure price stability. The recession worriers, led by voices like Fed Governor Christopher Waller, see a weakening job market and argue that high rates could tip the economy into recession. They believe a rate cut is needed to protect jobs and prevent a downturn. This split means the December decision will be contentious, with each side armed with compelling, yet conflicting, evidence. The outcome will reveal whether the Fed sees inflation or recession as the greater threat right now. The inflation hawks are laser-focused on the pain of high prices, groceries, rent, insurance, all still elevated. For them, inflation isn't just a statistic, it's a daily struggle for millions. They argue that cutting rates now could reignite demand and push prices higher, especially with holiday spending ahead. History warns that declaring victory over inflation too soon can backfire, forcing even harsher measures later. The hawks want patience, keep rates high until inflation is truly under control. They see the Fed's credibility on the line. Public trust depends on keeping inflation low. While they recognize economic slowdown risks, they believe runaway inflation is far more damaging in the long run. Their mission: protect the value of the dollar and prevent another surge in prices. For the hawks, any rate cut must wait for undeniable proof that inflation is defeated. They're willing to risk a short-term slowdown to safeguard long-term stability. On the other side, the recession worriers are alarmed by a cooling job market. Governor Waller warns the labor market is at stall speed, on the verge of contraction. Jobless claims are rising, and private employers are starting to cut jobs, reversing earlier gains. High interest rates are making it harder for businesses to borrow and expand, leading to hiring freezes and layoffs. The worriers argue that waiting too long to cut rates could trigger a recession, with widespread job losses. They want a preemptive rate cut to cushion the economy and support employment. For them, the risk of acting too late outweighs the risk of acting too soon. They acknowledge inflation, but see the weakening job market as the more urgent threat. Their case: the Fed must pivot now to prevent deeper economic pain. The Fed's challenge is compounded by a lack of fresh data thanks to a 43-day government shutdown. Key economic reports, jobs, inflation, consumer spending, were delayed, leaving policymakers flying blind. The Fed is now making decisions based on outdated numbers and anecdotal evidence from business contacts. This information vacuum heightens the risk of a policy mistake and deepens the divide between hawks and worriers. Without new data, each side leans harder on their own beliefs and models. Hawks argue it's too risky to assume inflation is beaten. Worriers point to stories of a slowing economy. The shutdown has turned the December decision into a high-stakes judgment call, not a data-driven one. The world's most powerful central bank is forced to rely on guesswork. The lack of clarity only intensifies the Fed's internal conflict. The Fed faces troubling signals from the broader economy. The job market, once strong, is now showing cracks, rising jobless claims, and shrinking private sector employment. The housing market is in crisis. Mortgage rates are at two-decade highs, making homeownership unaffordable for many. Home builder confidence is stuck in pessimistic territory, and first-time buyers are older than ever. This housing slump ripples through construction, manufacturing, and real estate jobs. Analysts predict a rebound won't come until at least 2026, and only if rates drop. The Fed is caught: keep rates high and risk deepening the crisis, or cut rates and risk reigniting inflation. Every option carries real risks for jobs, growth, and household budgets. The signs of weakness are too clear to ignore, but inflation's threat still lingers. The Fed's dilemma has no easy answer. The Fed's rate decision hits home for millions, literally. High rates mean expensive mortgages and auto loans, keeping homeownership out of reach for many. The housing affordability crisis is now a top political issue, with voters demanding relief. Unconventional ideas, like 50-year mortgages, are floated out of desperation, but don't address the root problem. The Fed, though independent, faces intense scrutiny from politicians and the public. A rate cut could boost consumer sentiment, but risks stoking inflation. Holding steady could prolong hardship. The central bank is balancing economic reality with political expectations, making December's choice even more consequential. As the Fed's December meeting nears, all eyes are on the latest jobs and inflation data, finally arriving after the shutdown. A strong jobs report could justify holding rates, a weak one could tip the scales toward a cut. Policymakers are desperate for clear signals after weeks in the dark. The decision will directly affect your wallet. A rate cut could lower borrowing costs, while holding steady keeps them high. The housing market, job prospects, and economic growth all hang in the balance. The Fed's internal split mirrors the uncertainty facing the entire country. As the final data arrives, the world will watch to see which risk, recession or inflation, the Fed chooses to confront. The outcome will shape the economy for months to come.